When it relates to commercial real estate finance, one of the biggest problems, especially if you don't do a lot of sales, is understanding who the players are and the fact that they operate under a very different set of rules than residential lending. This is one of the problems when your residential agents who start swimming in the commercial pond, this is one of the things they don't appreciate when they start doing this. And it's very difficult for full-time commercial practitioners. It's not a prejudicial thing where I don't want to work with you because you're residential. I mean, for some of you it might be ego-driven, but a lot of it is they just don't appreciate that the market is different. It is just not the same thing. The four basic types of lenders we have in commercial real estate finance. We've got the banks and credit unions. These are our go-to source for your local, mostly under 10 million. It's all recourse financing. Really quickly, what does that mean, recourse versus non-recourse? It's all about who signs personally for it. So in a non-recourse loan, if I go get a loan as the Tim Rios LLC, the liability stops at my LLC. If I sign personally, or what's called a recourse loan, they can come after everything I have. Banks and credit unions, almost 100% of the time in the last 10 years, are full recourse. And you can't get around this by, I've seen people say, well, I'll go start other LLCs or whatever. It's tied to your Social Security number and the Social Security numbers of the borrowers, so there's no way around that. It's personal recourse. We have the conduit lenders, which have come back very, very strongly. Back 2008, 2009, 2010, they took a massive hit. These are the people who lend money but then securitize it in the CMBS market, or the commercial mortgage-backed securities market. The great thing about CMBS loans, especially back in their heyday, was they were primarily non-recourse. There's just too many moving parts. By the time you securitize the loan and everything to come back on specific borrowers, they just figured wasn't worth the hassle. So CMBS was a really hot product for a long time. It's come back with a vengeance because it does fill a niche in the marketplace. Banks and credit unions, everybody has their different types of do's and don'ts, and CMBS loans would often take a much broader range of properties, maybe things that wouldn't qualify for a traditional financing, especially those last two, the agency and the life company loans. The agency are primarily multifamily lenders, although they do have some small commercial programs. But this is your Fannie Mae and your Freddie Mac, your DUS lenders, your delegated underwriting and servicing lenders. It's a go-to source for multifamily lending, primarily over about the $2.5 million to $3 million threshold. They do have a small balance loan program. It's not as popular as their large balance loan program, but again, it's primarily a multifamily tool backed by Fannie and Freddie, which there's a longer story about them, but in the interest of time, we won't go into that history lesson. And then lastly, there's the life insurance companies, but they are driven and restricted by the same things we talked about from an ownership perspective. They cannot risk their rating as an insurance agency, so they tend to cherry pick only those trophy assets. Some of the biggest differences that you run into, especially when residential people come to work on your deals, sales deals, is we have so many things that we benefit from in consumer lending in this country that do not exist in commercial lending. All the legislation, including the 1968 Truth in Lending and follow-on legislation, Reg Z, as well as ECOA, the Equal Credit Opportunity Act, created a lot of protections for consumers. And it was a good thing because prior to that, we'd walk in and you could say, let's say John was offering loans and he'd say, I give loans at 5%. And that's great. And I walk over to Marcia and she says, I'm offering loans at 4 3/4. So on face value, whose loan would you prefer, Marcia's or John's? I would prefer Marcia's too at 4 3/4. It's a better rate, right? The rest of the story was Marcia would say, okay, well, I have 2 points in a discount fee. I've got a 1 point origination. I have this fee, I have this fee, I have this fee. And John says, well, I don't really have any fees associated with my loan except a 1 point origination. Now who's a better loan? Maybe. We don't actually know because that was the problem is consumers had no way of mathematically reconciling that in their mind. And so part of what happened in this legislation was the government created the APR. We've all grown up with that. So we think, well, APR, isn't that what they all do? It's what they do because the government made them do it. It was to mathematically roll up all the costs of those loans into one number so a consumer could say, oh, John's APR is 5.25, Marcia's APR is 5.35. It was an easy way for them to do apples to apples. What is the equivalent in commercial lending? Trick question, there is none. That's the problem. The government figures by the time you're swimming in this pond, you just better know what you're doing. So your ability to judge a loan is about your specific situation. And that's why commercial lending is so much harder to navigate, because you've got to know what your client is trying to accomplish, or you cannot advise them properly. Everybody is well, I shouldn't say everybody, but most of your more amateur type of owners, think about it, for a lot of these investment sales, they don't do this every day. So they tend to be hyper fixated on rent, because when they go to buy your house, that's about all there is to it. 100% of conventional loans in the United States of America are prepayable without penalty. I can't remember the last time if I've ever in 25 years seen a commercial loan that was prepayable without some type of a penalty. It's just a different world. Okay. We all know in commercial real estate finance, there's a couple of things I want to get to that are a little bit more important. Everything, this is one of the reasons why, for those of you in capital markets, investment sales, 3, 5, 7, and 10 years is a great time to call private clients. Why? Loans are due. So when I would download title company records and back in the day, and I would say, oh, they got a loan 7 years ago or 10 years ago, it's probably a good time to maybe up my frequency of wanting to talk to them, because while the payment might be based on 20 or 25 or 30-year amortization, there are almost no fully amortizing loans in commercial finance. Maybe in some of your highest end, top credit, Walgreens types of deals, you might get fully amortizing financing, but otherwise you don't. The other big issue that we deal with is prepayment penalties. So I'm assuming a lot of you own your own home. You could tomorrow sell your home and prepay it without penalty. That basically does not exist in commercial real estate finance. 3 different types of ways we prepay loans if they're not locked out, because sometimes there's a period of lockout on our loans. Number 1 is stepped. This is most common in your banks and credit unions. It's a step prepayment penalty based on the number of years left in the loan. So it might be a 5, 4, 3, 2, 1, and then in a really magnanimous gesture, there'll be no prepayment penalty 6 months prior to expiration. How generous of you. Thank you. Okay. Typically a bank and credit union. One that has gone away mostly is yield maintenance. So in the early days, especially of CMBS loans, we had yield maintenance. Now think about why we even have to have this. If I originate a loan and then I sell this off to a bunch of investors, I can't go back to 1,000 different investors and say, oh, Galvin wanted to prepay his loan. Can I not pay you your bond payments? You think that would work? It doesn't. You have to maintain the cash flow stream. So yield maintenance was this factor that you had to pay so that the lender could continue the cash flow stream payments. But then the lenders thought, that's a lot of work for us, and we don't want to have to do that. So then they came up with defeasance. How many of you ever defeased a loan? Count your lucky stars you've never had to defease a loan. Defeasance is, let's say you have $5 million left on your loan balance. Defeasance is you have to buy a basket of U.S. Treasury securities that mimic the cash flow stream and the maturity of your loan. How easy do you think that is to do? You can't do it. I can't do it. You have to hire a bond trading company to do it for you. They design the basket. They go out and buy it. The last time I defeased a loan, I had $70,000 in fees. Fees alone, not paying off the loan. $70,000 to buy the bonds to defease the loan. Okay? And you deliver that basket of securities to the lender as and then guess what? Then you're out of the loan. How great is that, huh? So that's kind of where we have moved to in the market. If you're not a bank or credit union where it's a step prepayment penalty, you're probably looking at the need to defease a loan, and you can't do that on your own. But this is one of the reasons why the deeper issue here and the discussion that we want to have offline or whenever you have with your team when you get back home is, how do you properly advise a client to navigate this world? Because it's not as simple as 5 and 4 3/4 or whatever. It's what are you trying to accomplish? What do you see as potentially your horizon for selling? What's the credit quality of the underlying borrowers? This is not amateur hour. This is much harder to do than most people give it credit for being. These are critical issues for your commercial lenders. These are things you generally cannot negotiate your way around. These are things that they will require as part of your contracts. Okay? If you have a termination right, if you have a 10-year government lease with a 3-year kick-out, what do you have? You have a 3-year lease. Okay? That is all the lender is going to give you credit for. Assignability and novation go hand in glove. This is something that you've got to be, again, working with your clients. I worked with a client, a Big O franchisee years ago. He wanted to sell his real estate, but he also knew he wanted to retire within 5 years. So part of what we had to negotiate in his new lease, as well as with his lender, was the ability to not only assign his lease, but to be novated. Novation means that you are completely let off the hook. So oftentimes there's layers of assignability. So I could assign a lease, but if that assignee goes belly up, then they come back to me. So I'm actually not off the hook from a liability standpoint. You have to be fully novated, otherwise there is recourse against you. Subordination, non-disturbance, and attunement. What does that mean? Okay, so 3 pieces to an SNDA. Most tenants, you cannot negotiate them. They're part and parcel to today's commercial leases and lending agreements. Each thing means something different. In lien priority, who's typically first in line? Okay. Only because of the SNDA. So by law, forget government for a minute because government can jump the line on anybody. By law, whose lien has seniority if something goes wrong? Whoever was first. It's first in line. Remember, the government can always jump the line, as well as a mechanics lien can jump the line back to the date that work started. So if I'm a lender that comes in and there's 15 tenants in this office building, by law, that new lender's rights are junior to the tenant's rights. How many lenders do you think will make a loan being junior to the tenants in the building? This many. Okay? So that's the subordination. You sign that which says your rights are now junior. I know I'm later in the game as the lender, but you are subordinating your rights to me. Non-disturbance, though, is the tenant's protection. Non-disturbance says that although I'm subordinating to you as the lender, you respect my right to continue operating my business, and the only reason you can kick me out is if I'm in default of the terms of my lease. If you have no non-disturbance, if you just subordinate a loan, your lender could actually come in and terminate that tenant's lease. Okay, so non-disturbance is the way that the tenant is protected in an SNDA. Attunement is the way that you transfer the rights from one landlord to another. That says if I sell my property to Frank, then Frank is recognized as the new landlord without any other formal transfer.
Quick question. I've done work with some medical cannabis companies and leasing inside of a shopping center. And since it's federally illegal,
Yes.
points, but not in the state, if there's an SNDA signed in there, would that apply to the tenant as well?
Yes.
So they would be protected. They couldn't step in and force foreclosure on a property because they leased to medical cannabis?
That's the non-disturbance. So that's when you are negotiating, you got to be careful because sometimes these agreements get a little too one-sided, where the subordination language is heavier and you want to have them balanced. So non-disturbance basically says, I'm a medical cannabis company. I have the right to do this under state law. This is my terms of my lease. You will respect them unless I'm in default. So they would be protected like any other tenant in that particular situation. And I know it's tricky because of the federal versus state regulations. But so far, I don't think we've seen too much trouble at the federal level coming in at tenants for that.
Well,
But
trying to find locations for them to go in live, because they have a mortgage. The biggest thing brokers have been telling me right off the bat is, well, they have a mortgage and federally regulated, so we can't lease to you. Now, maybe just ask
Good point.
the question in the SNDA, is that part of that? Like, how is the subordination done, and do they have the right for the lender to step in and kick them out?
So that's not an SNDA issue. You're right, that's a mortgage issue. And I know that this is related. SNDAs can be in leases as well. So SNDAs is something that we see in leases, we see in mortgages, but on a federally backed or a federally insured mortgage, I could understand why that language would be in there. And so in that case, I would tend to take my clients to a state-chartered bank or credit union if that's served the financing purposes. I'm not a lawyer, but that's kind of what my gut tells me on that, is I would stay away from, because I could see somebody raising that issue.
Figures like